this year has been a tale of two markets. Through July, it was risk on. Why? Because the market was seeing surprises in terms of oil prices coming down, auto prices coming down, and saying, oh, the Fed must surely be done. And then we get a CPI print or a PCE print that disappoints, and the Fed continuing to say, oh, no. Well, higher for longer, and we absolutely will raise interest rates if we cannot see 2% inflation. So I think they're in the process of making a mistake.
Welcome back to Money 101. In our latest report, we present the recent conversation with Cathie Wood, the CEO of ARK Invest, providing valuable perspectives on the market and projections for the year 2024. The effects of Federal Reserve policymakers' decisions on interest rate hikes are noticeably felt across the United States. Officials tread cautiously in signaling the conclusion of their measures to counter persistent inflation, drawing from lessons learned in the 1970s when premature easing resulted in a resurgence of double-digit price increases. While the Federal Reserve Bank of San Francisco emphasizes that claiming victory over inflation is premature, investors are speculating on whether the upcoming rate cuts in Fed meetings will mark the end of the current credit tightening cycle. This speculation has led to an upswing in stock and bond prices, reflecting both market confidence and the Federal Reserve's communicated intentions. Tune into our recent interview with Cathie Wood as she shares her insights on the outlook for 2024, touching on anticipated economic indicators, discussing topics such as inflation, the stock market, and the potential impact of cryptocurrencies on the global monetary system. If you found this information valuable, please consider subscribing. Your support means a lot to us.
We're getting more proof of concept on deflation too. So it starts at the commodity level, always does, right? Copper prices peaked at $5. They're now about $3.50. Oil even, is down to, well, it's in the 70s, but even more interesting to us is gasoline is pointing to much lower oil prices. The demand destruction in gasoline right now, because of the pricing, is so high. I think gasoline demand was around the Labor Day holiday, hadn't been this low in 25 years, something like that. Big demand destruction in all kinds of categories, including staples. Now, the Procter & Gamble's and staples companies, they took full advantage of supply chain crisis and jacked prices up. Guess what? Their volumes are falling. That is not a good recipe for a manufacturing company. You want to keep your manufacturing plants running full time. And now they're seeing a pullback in unit volume. We're seeing in the S&P 500, about a third of the S&P 500, a third of the companies are showing falling revenues. Falling revenues. That means the combination of units and pricing, that combination is down. If you look at commodity prices as measured by the Bloomberg Commodity Price Index, they are today where they were in the early 80s. They've gone nowhere.
Wow.
M2 growth has been negative all this year on a year-over-year basis. The yield curve has been inverted all year, actually almost a year and a half now, roughly a year and a half.
But no recession yet.
Rolling recession. Housing, by some measure, sales down 40%. That's a recession there. Auto sales, 15 million units. That's recessionary. Falling prices as units fall, that sounds recessionary. And that's happening in staples. Home Depot today, sure, it was one of the biggest beneficiaries, but it's been 2 to 3 years now, and it's still saying minus 3% same-store sales growth. That's both price and profits, and deeper negative here in the U.S., minus 3.8. So I'm looking at statistics and I'm listening to earnings calls. When I listen to earnings calls, and I listen not just to ours, but to other more cyclical companies, just to get a sense of the economy. You listen to them and you'd think we're in a recession. Now, it depends on the area. We're in today's CPI. You saw auto prices coming down. You saw airline prices coming down. So you saw education prices coming down. Oil and energy transportation we knew about. Rents, the pop last month reversed, didn't go negative, but in the real world, we're hearing about serious rent declines or serious discounts, like 6 months free or 1 month or 1 year free. So I think it's all around us. The Fed is paying attention to lagging indicators. One is the CPI. It's gone from 9 to now roughly 3. We think it's going to turn negative before all is said and done. The other one is employment. Now, what the heck is going on in employment if what I just told you is true?
Right.
We know how many companies had such trouble finding anyone as we were coming out of COVID. They're reluctant to fire people even though their margins are starting to fall, so they don't want to go through that again. Well, M2 growth has been negative all this year on a year-over-year basis. The yield curve has been inverted all year, actually almost a year and a half now, roughly a year and a half.
But no recession yet.
Rolling recession. Housing, by some measure, sales down 40%. That's a recession there. Auto sales, 15 million units. That's recessionary. Falling prices as units fall, that sounds recessionary. And that's happening in staples. Home Depot today, sure, it was one of the biggest beneficiaries, but it's been 2 to 3 years now, and it's still saying minus 3% same-store sales growth. That's both price and profits, and deeper negative here in the U.S., minus 3.8. This year has been a tale of two markets. Through July, it was risk on. Why? Because the market was seeing surprises in terms of oil prices coming down, auto prices coming down, and saying, oh, the Fed must surely be done. And then we get a CPI print or a PCE print that disappoints, and the Fed continuing to say, oh, no. Well, higher for longer, and we absolutely will raise interest rates if we cannot see 2% inflation. So I think they're in the process of making a mistake. But in the beginning of the year, people were saying, okay, the numbers are coming down, inflation's, doing what it should do. Then we had this pause where, are we stuck here at 3 to 4%? Many people think we are because they see these wage hikes going through, 10% per year, 6% per year. And they say, surely we're back in a 70s style inflation. And that, that's what the Stanley Druckenmillers and the bears out there are thinking. We think that is absolutely wrong, that the resolution of that 10% push in wages per year will end up in lower margins. Big problem, not in higher prices. Big difference, very big difference. And so I think it's from the end of July through the end of October, we went through this big nervous period where the long bond yield started rising relative to the short-term yields. Still an inverted yield curve, but long yields were rising. It was a bear flattening, not a bull flattening. A bull flattening is when short rates come down relative to long rates. So a bear flattening went risk off. People sold our strategy, sold anything risk off, and moved back to their benchmarks, moved into cash, huge amounts of cash on the sidelines. Now we're getting more prints again that are saying the Fed probably has overdone it. And you just listen to quarterly company calls, and you listen to these management teams, and we have lots of callbacks with managements, and they say, why are you the only one seeing recession? Why can't the Fed see this? This is what we're going through, just on the expectation of rates going up. And then on the reality of rates going up, we were crushed in 2022. The market has discounted what the Fed has done. I don't think the Fed's going any further. If the market can feel comfortable that that is indeed the case, we don't have to have rates even come down. We think they will, but we think that certainly our strategy has discounted the worst. I don't think value stocks have discounted the worst of the cyclical part of the recession. We tend to be recession resistant. The last leg here is going to be consumption. And we'll see how the holidays fare, how deal-driven consumers are. We think they're really deal-driven.
Cathie Wood brings attention to the evolving landscape of crypto legislation in the House, signaling a growing interest in the crypto space. Despite potential opposition from certain figures, Cathie remains optimistic, believing that the ongoing dialogue alone will positively impact the crypto market, paving the way for potential growth opportunities. She also delves into the current monetary policy, echoing Chairman Powell's characterization of it as restrictive, raising concerns about inflation rates. The potential rise in real interest rates could influence investment decisions, making alternative assets like Bitcoin and other cryptocurrencies more attractive due to their resistance to inflation. Share your thoughts on Cathie Wood's recent interview, where she provides insights on government debt, rapid economic growth, and the ever-evolving landscape of cryptocurrency. Drop your comments below and we'll catch you in the next video.